as Michael mentioned, I am a senior gift strategist. That doesn't mean much to people outside of this industry, but I want to create a unique giving strategy for each of my clients. So every client we're working with, we're kind of figuring out what are their giving goals and how can we best meet those goals. I am originally from the Midwest, but I live in Colorado Springs now, so needed some mountains and sunshine in my life. So my husband and I and our dog live in Colorado, and we just love hiking and backpacking and all things that Colorado has to offer, but love getting to work with clients and donors and ministries all over the country. Just a quick snapshot of WaterStone and kind of our focus. We want to be able to get the most money to the kingdom that we can. So here you can see that we've handled more than 1 billion in complex asset contributions. So real estate, privately held business interest, marketable securities, agriculture, all the weird stuff that you can give to charity for tax benefits. We have also sent out more than $1 billion in grants. So you will hear that, yes, we have expertise in receiving contributions, but we have such a heart for giving, and we want to be able to grant these funds to your favorite charities. We've supported more than 7,500 different charities all over the country and international as well. If we can help with any needs internationally, we give about $2 million every single week in grants. This is typically between 300 and 400 different organizations, just a reflection of our donors and who they want to support. So it might be a donor's local church, or it might be a national organization. We don't only support Christian ministries. Most of our grants are to Christian organizations, Christian ministries, but we can also support secular organizations as well, as long as nothing is antithetical to our statement of faith. And we have close to 1 billion in assets under advisement. So we're a little bit up from that 950 million number presented here, and we're really excited to hit that 1 billion mark. So why use WaterStone? We are going to partner with your financial advisor. We're going to partner with your alternative investments. We're going to partner with your ministry to help get the most that we can to charity. So we are always going to honor the donor's wishes as we are fulfilling your grant recommendations, and we can give to any organization consistent with our statement of faith. So we will not give to like a Planned Parenthood, for example, something that is antithetical to our statement of faith, but we can give to the Red Cross or the Humane Society or different organizations that aren't necessarily faith-based. What that means is we will give to family values groups. So we will give to First Liberty, Alliance Defending Freedom, Focus on the Family, different organizations that in some circles are under some scrutiny about what they stand for and what they support. WaterStone we will always give to those family values groups that have similar values to our WaterStone at its core. All right, so let's get into the nitty gritty. And this is where I kind of spend all day, every day. So again, feel free to put questions in the chat box. Michael can interrupt me as needed, or we can also do questions at the end. But this is really where the potential for charitable giving is. When we think about charitable giving, we think of writing a check. We think of going to a golf event or a gala and pulling out our checkbook and writing a check in order to support this organization. We aren't looking for what really makes up somebody's net wealth. So we like to use the idea of an iceberg. When you see the tip of an iceberg, all that you see is just the tip. You're not seeing all that's below the surface. And so when we are asking for charitable giving, we want to ask from someone's entire net wealth. What makes up their wealth? What are their assets that they are able to give? So rather than only asking for that 9%, less than 10% of somebody's net wealth is actually going to be in cash or liquid portfolios, I should say. And so what we want to be able to look at for charitable opportunities is those appreciated marketable securities, that real estate, oil and gas, agriculture, business interest, privately held business interest, S corps, LLCs, partnerships, C corps, all kinds of different privately held business interests, even life insurance. There's a lot that's going to make up somebody's net worth that we can ask for charitable benefits. And these assets that are below the surface that we don't typically think about for our charitable giving actually have a double tax benefit. You can completely avoid capital gains when you donate one of these assets or a portion of one of these assets. And the donor also receives a fair market value charitable tax deduction. So let's just take a simple example of that appreciated Apple stock that you've been holding on to for years, because if you sell that Apple stock, you're going to have to pay significant capital gains taxes on the appreciation. So if you're going to sell that Apple stock, you're going to have to pay capital gains. Whatever is left is going to, be available for giving to charity or investing elsewhere. If you give cash to charity, you will get a charitable deduction. What WaterStone recommends is donate that Apple stock to charity. Donate the Apple stock. When the charity sells the Apple stock, WaterStone, for example, is a 501c3 tax exempt entity. When we sell that Apple stock, we will not need to pay any capital gains. That entire amount is going to be used for charitable purposes. So instead of paying that amount to the IRS, to the government, we're now sending that money to our favorite charity. And the donor also still receives a fair market value charitable tax deduction. So you get a charitable tax deduction for the value of that Apple stock on the date that you gave it. It's technically going to be an average of the daily high and low trading value of that stock, but it's a really fantastic way to receive a charitable tax deduction and also avoid those capital gains. Very similar concepts work with other assets like real estate or oil and gas, business interest. The business owner that maybe they have a dental practice or all kinds of different privately held business interests that can also be available for charitable giving. So a couple other benefits. So there's double tax benefits, but there's other benefits as well. You can give an undivided partial interest to charity. So it doesn't have to be, if you're selling real estate, you don't have to donate all of the real estate. You can donate 10%, 50%, 75%. If we're looking at your privately held business, WaterStone doesn't want to be a majority owner in your business. We don't want to be making decisions in an operating company. We're a 501c3 foundation. And so but let's talk about a 10% gift, a 15% gift, a 30% gift, a 49% gift. And we can look at the different tax opportunities available there for an undivided partial interest gift. The other benefit is once we've sold this asset, we've avoided all the capital gains, we can invest those proceeds and any growth is going to be completely tax-free. Technically, the funds are owned by WaterStone, they're owned by the 501c3, and so any growth in that investment account is going to be completely tax-free. Whether we are, investing with Michael Mandarino, or if we're invested in some alternative investments, or we've got a wide variety of options for you, but any growth will be completely tax-free. And then there's also flexible giving. So now these funds are all available to go to your preferred charities. And there's a lot of different ways to do that through a giving fund. And we'll talk a little bit more about those giving funds in just a minute. So here's the number one thing I want you to learn. I want you to walk away with. If you don't remember anything else I said today, the only thing you need to remember is to give first, then sell. This is absolutely huge. You need to give the asset before there's any kind of binding sales agreement in order to get all of these tax benefits. So we are giving first, then we are selling. Here's a few different scenarios to make this stick a little bit. So if we're not gifting at all, this is just looking at federal taxes. We're not looking at any kind of state taxes. If we don't gift at all, we sell our asset outright. Of the proceeds, we're going to have to pay 37% to the IRS, and the donor will keep what's left over. What if we sell it first? If we sell the asset first and we give some cash to charity after the fact, that's this middle pie chart. So you can see that the amount to the IRS has been reduced because we're getting a nice charitable tax deduction for our cash gift to charity. So the donor ends up with a little bit less, but charity ends up with more and the IRS ends up with less. The final category over here is to give the asset first. Look how much we can reduce those taxes. So in this scenario, we are still paying some IRS taxes. We're looking at some other income. There's other tax implications other than just capital gains. We've got some W-2 income or Social Security income, but we've significantly reduced our tax liability in the year of this gift. Charity has gotten way more. And in this scenario, the donor ends up with a little bit more in their pocket by giving more to charity because we gave first before we sold. Again, give first, then sell. All right, so a little bit about the tool that we use to receive these assets, and we'll talk about a couple different tools, but the first one is a donor advised fund. So if you're not familiar with the donor advised fund, you can think of it like a charitable bank account. WaterStone likes to call our donor advised funds giving funds because that is the focus, is being able to give these funds away to charity. I like to think about it as 3 different thought processes. So there's 3 different aspects to a donor advised fund. The first is where I live. This is give. This is clients being able to give all kinds of different assets to charity. This is receiving real estate, business interest, oil and gas with all of those tax benefits that we just mentioned. The middle column, the middle process, is where Michael Mandarino lives. This is the grow phase. This is being able to invest those proceeds destined for charity and being able to grow them tax-free. So we are happy to open up a separately managed investment account with your financial advisor in order to manage the accounts and create a unique investment strategy for you. We do also have some WaterStone investment pools that you can join as well that are kind of low-cost index funds to be able to be good stewards of these resources. And the granting side of the house is really where we get the joy of giving. We've now created more resources available to give to your preferred charities. So we have an online donor portal. You can log in, recommend grants to your preferred charities now or over time. We can send all of the proceeds out as soon as there's a sale. We can send out funds over the next 5, 10, 15 years. Or we can run it like an endowment. We can send out income generated and create a legacy of giving through these accounts. There are options for anonymous giving. So you can give all of your information to the organizations we're supporting. You can be partially anonymous. You can give them your name, but maybe not your address. You can give them the name of your fund, but maybe not all of your details, or you can choose to be fully anonymous. WaterStone will do due diligence on every organization we support. So we are going to make sure they are a registered 501c3 in good status with the IRS. And we're going to review kind of their mission statement. We're going to make sure nothing is antithetical to our statement of faith. If we have any questions or concerns, we will reach out directly to you to talk about, what are your charitable goals? What are you trying to support? If you have any questions about charities or, need recommendations, we're happy to walk alongside you and help to figure out some of your charitable goals as well. And the best part, again, I'm a CPA. The donor advised fund helps to simplify your tax reporting. So at the end of the year, you get a cumulative annual tax receipt from WaterStone for your charitable deduction for that year, instead of looking for a tax receipt from the 20 different organizations you supported that year. So, instead of looking through your email and your mailbox and getting all kinds of different receipts at different points in time, now you've got one tax receipt. You have really simplified your tax accountant's job when trying to claim your tax deduction.
And Stephanie, one thing on what we use with our clients and our donors is if they're, let's say, tithing to a church or ministry about $10,000 a year, they make $100,000. Typically, they can't get over the standard deductions. So we recommend them opening up a donor advised fund in December and put in the money that they're going to be donating for 2024. But now that deduction happens this year, and that's really kind of the beauty of it. So I just wanted to, I think it's just great. So thank you for that. I just wanted to share a little technique.
Exactly. I like to call that bunching, where you give essentially 2 years worth of charitable giving in one tax year. You get to itemize your deductions 1 year using that large charitable deduction. The next year, you already have all of your resources available for charitable giving, but you've already taken that tax deduction. And so now we can really benefit from that higher standard deduction. We can kind of do that for, every other year or every few years. You can really pre-fund a lot of your charitable giving. All right. Here's another just kind of simple illustration. These are illustrations that I create custom for each donor. Similar to that pie chart where we've got those 3 columns. The first one where we're not gifting anything at all. The middle column where we're doing what most givers are going to do. They're going to sell the asset and give some cash after the fact. And then the final column is what we can do if we can gift pre-sale. So this is just appreciated securities. We've got $300,000 of securities with a $50,000 cost basis that we're looking to sell. In this case, we're going to look at what it looks like to sell outright, what it looks like to sell and give cash, what it looks like to give the stocks themselves. I am looking at kind of worst case scenario tax rates. So looking at federal income taxes of 37%, capital gains of 23.8. That 23.8 assumption is a 20% capital gains tax rate and a 3.8% net investment income tax. And then I don't know if any of you live in California. We've got a lot of donors that live in California with substantially high state tax rates. It can even be as high as 13.3%. And so this is a good illustration for you guys of kind of how much we can save in taxes with some of these scenarios. So again, first column is no gift at all. We sell the stocks outright. We have to recognize $250,000 of gain. I've got other income in here because that's going to come into play with some of our AGI limitations on that charitable tax deduction. But in this case, we don't have any kind of charitable tax deduction. So we're paying capital gains taxes on that appreciation. We're paying ordinary income taxes on our standard other income. And at the end of the day, the donor walks away with, in this case, $700,000. In the middle column, we are still selling the asset. We're still recognizing all this income, but now we are giving $300,000 in cash to a donor advised fund or to our preferred charity. So now we're still paying capital gains tax, but we are able to reduce that ordinary income tax rate. So the great thing about charitable deductions is you will first use it against your higher ordinary income tax rates, and then you'll use it against the lower capital gains tax rates. So we are first able to reduce that 37% tax bracket. And we have saved almost $150,000 in taxes by making this $300,000 gift to charity. So again, it's not a 1-for-1. It's not a tax credit. It's a tax deduction. But we are able to use this whole deduction in the year that we made the gift. And at the end of the day, we're saving $150,000 in taxes. Between the donor and charity, we're getting way more funds to the donor and the charity. The final column, we are gifting these securities before we've sold them. And again, this can work with real estate or with privately held business interest, but we are avoiding all of the capital gains because the charity is the one that sold them and they don't need to pay those capital gains taxes. But we're also getting a fair market value tax deduction. That's the double tax benefit, avoiding the gains and also getting the deduction. So now we aren't recognizing any capital gains taxes. We're using our deduction to offset those higher ordinary income tax rates. And we have now saved more than almost $240,000 in taxes by making this one-time $300,000 gift. So way more money went to charity. We actually have more money in the donor's pocket. And the IRS got a significantly less portion of this transaction. All right, so that's a donor advised fund. Charitable bank account can receive all kinds of different assets. I also wanted to touch on another opportunity that can receive some of these assets, especially real estate or C Corp interest. LLC, it kind of depends on the tax structure. S Corps, unfortunately, cannot be donated into CRTs, but these are a really, really fantastic way to prioritize income to the donor, still minimize those taxes, and truly optimize giving. So a charitable remainder trust, it can receive cash, it can receive marketable securities, it can receive that real estate. The donor gets a deduction today for the value that charity will receive in the future. So it's a present value calculation. You're not getting an immediate 100% tax deduction, but you are getting a tax deduction today. But charity is actually not going to receive those funds until the future, until the end of the term of the trust. Until then, this trust is going to create a lifetime or sometimes a fixed term income stream for the donors or maybe your kids, depending on how we've established this charitable remainder trust. So this is a split interest vehicle because the donor is going to continue to retain that income stream, oftentimes for 2 lives. Oftentimes it's for the donor and spouse. For their lifetimes, they'll receive this income before the remainder passes to their preferred charities. This is going to reduce the donor's estate. This real estate contributed to the charitable remainder trust that's providing income to the donor is actually not in the donor's estate anymore. This is completely removed from the estate. So if we're looking at estate tax considerations, this is in a completely separate charitable entity. The remainder is going to pass to a giving fund or to any kind of 501c3 that you would like to use. We recommend a giving fund because of all of the flexible giving options that can be set up to be able to allow you to give immediately or over a term of years or in perpetuity. There's lots of different options, and it's really easy to change any of those charitable organizations that you'd like to support. WaterStone can serve as trustee. We can work with your advisor to manage the proceeds of the sale from that real estate. We will oversee the beneficiaries, the income payments, and we also do all of the back-end tax reporting. So we will do the K-1s, we'll receive the 1099s, and we will file the annual tax return for the CRT. So here's kind of a visual of how this works. The donor makes a contribution to a charitable remainder trust. The donor receives a partial tax deduction. The donor will also receive an income stream, often lifetime, to their beneficiaries. So maybe that's a husband and wife, maybe it's to their kids. And then after the term of the trust, the entire remainder amount can go to charity. For the CRTs, there's several different ways to schedule that income payment and what kind of income stream you're looking for. So many people are aware or familiar of annuities. So we can do a charitable remainder annuity trust where you receive a fixed dollar amount. So maybe this is monthly or quarterly, annually, that you're going to receive a fixed dollar amount from this trust for the entire term of the trust. You have to be a certain age, and the charitable deduction is going to be a little bit lower for an annuity trust. Another option is a unit trust, and this is what we see most often. This is a fixed percentage of the assets valued annually. So every January 1, we look at the value of the trust, and let's say that it's going to be a 5% payout. We calculate what that 5% payout is going to be based on the balance of that trust that January 1. Now, if we've earned 8% in the trust and we're only paying out 5% of the trust, that trust has grown over time. And next year, when we calculate 5% of the assets, that payment amount could grow. The opposite can also happen. Payments can go down over time. Most often we see them going up over time, and these are typically long-term charitable trusts. So we call that a CRUT, a charitable remainder unit trust. Another option for the payment is a pooled income fund. In a pooled income fund, we mix the assets with other donations as well, and we pay out income generated every quarter to the original donors. So this is going to be a much more variable income stream based on the performance of the investment account. And if we're paying out any interest, dividends, short-term capital gains, we also pay out 50% of long-term capital gains. The donor receives a much larger charitable deduction when they first contribute to a pooled income fund, because we know for a fact that we will never be eating into principal. The entire principal amount of this trust will be left for charity at the end of the day. So there's right now through the end of 2023, The charitable tax deduction that you give if you choose the pooled income fund type of charitable remainder trust, your tax deduction will be almost double what it would be if you chose the unit trust. That's going to change next year as some of those calculations are catching up with raising interest rates, but it's another great option for a donor to continue receiving income and know that they're going to support all their favorite charities after they pass away. Setting up a CRT is really easy. It's an irrevocable trust. So, changing the income beneficiaries or the payment type, that kind of thing, we won't be able to change once it's funded. We recommend a minimum of $250,000 to begin contributing to a CRT. We can run some initial calculations for you to understand what that charitable deduction would look like. We just need to know the fair market value of the asset or cash or the appreciated assets you're looking to contribute. If we know the birth dates for the income beneficiaries and the payout percentage we're looking to earn, we can give you an idea of what kind of charitable tax deduction that looks like. Once we can get the CRT documents drafted, WaterStone has an attorney on retainer that can draft all these documents for you. Once it's signed and notarized, WaterStone will record the CRT with the state, and we will obtain an EIN from the IRS. Then we'll fund that CRT with maybe it's real estate, maybe it's C Corp interest, maybe cash, maybe the Apple stock that we talked about. And then WaterStone can provide that charitable deduction calculation for you. So it's pretty simple to set one of these up. And I just wanted to go through a really quick case study of a scenario where we had some donors that donated real estate. It was actually a McDonald's property into a charitable remainder unit trust, into a CRUT. So husband and wife, they owned this property. They were receiving an income stream from McDonald's every month for leasing this property out to them, $7,600 a month in income. They needed this income. They lived off of this income. This income was very important to them. They had other assets they were going to distribute to their kids when they passed. They didn't want to have to deal with transferring the ownership of this lease and having to deal with kind of all the negotiations and maintenance and all the other stuff that came up on this property. And so what they did is they donated this McDonald's lease, this real estate, to a charitable remainder trust. The charitable remainder trust sold the property to McDonald's. McDonald's did have a right of first refusal to buy the property, so we did have to offer it to them first, and they did need to be involved in the donation aspect as well. We met with the whole leadership team at McDonald's and their team of attorneys to make sure that we did this transfer correctly. The donors, the husband and wife, received an immediate tax deduction of $820,000. So this was about a $2 million property, and they received an $820,000 tax deduction in the year that they made this gift, even though no money is going to go to charity until they both pass away. Now, the really cool thing about this is they did an 8% CRT unit trust payment. So they are actually getting close to $12,000 in income every single month from this charitable remainder trust. So we have increased the amount of income they were getting off of this property, but now they no longer own the real estate. Now it's in an investment account with their specific investment manager who was able to create a unique investment policy for them. And so we are able to get way more money to charity. We didn't have to pay money in capital gains taxes. I think here I have that they would have paid an estimated $600,000 in capital gains taxes if they were to sell this outright. So they could have done a 1031 exchange and kept deferring the taxes and kept, being invested in real estate. But this was a fantastic way for them to divest from this real estate, to not need to worry about their kids needing to split this property and possibly going through probate. And McDonald's was thrilled. They were absolutely thrilled to be able to own this property. They were able to buy it when interest rates were really low. And now this is one less leaseholder that they have to worry about on an annual basis. That's a really great example of how donating real estate to a CRT can continue to provide income to the donor, but we also are avoiding those capital gains and getting a really nice charitable tax deduction up front. One more real quick illustration of how to use a charitable remainder trust is looking at IRAs. So when the Secure Act in 2019 came out, it kind of changed the landscape of how a lot of us deal with IRAs and inheriting IRAs. So before the Secure Act in 2019, beneficiaries of these IRAs could stretch the IRA savings over their entire life expectancies. What the Secure Act in 2019 put in place was that we only have 10 years to withdraw all of those funds. And so if we look at funding a CRT with an IRA, this would provide an option for our kids to take this out over maybe 20 years, maybe their lifetime, and still continue to receive this income. So we recommend designating a CRT as the beneficiary of your IRA. This could be, again, a lifetime or a term of years. The maximum term of years you can do is 20 years. We see a lot of people that like to do this 20-year income stream for their kids and then allow that remainder to go to charity. After that, the remainder is going to go to charity, and the contributed assets aren't subject to tax until they're actually distributed to non-charitable beneficiaries. So it really helps to preserve those assets for charity. Here's kind of an idea of how that would work, very similar to that McDonald's illustration. But this, I think, is going to be the most powerful. So let's say this is $1 million IRA. We're returning about 6% a year, and the beneficiary is about 55 years old when they are going to inherit this IRA. So in the very first column, our IRA, we're receiving an inherited IRA. We have 10 years to pull this income out. We have 10 years while our beneficiary is still in their high income earning years. So, they're between ages 55 and 65. They're still working full time. They're still earning a lot of income. They're in those higher tax brackets. So we're going to be paying, we're going to be receiving $1.3 million from the IRA over 10 years. And we're going to be paying almost $650,000 in taxes on those IRA monies, and nothing is going to charity. Let's say we did a charitable remainder trust for a 20-year term so that this beneficiary now gets income for 20 years instead of 10. And let's do a 6% payout. So now the income to the beneficiary over the next 20 years is going to be about 1.2 million. But now half of those years, we're in retirement age, we're in a lower income tax bracket. So we're going to be paying closer to $500,000 in taxes, and $1 million is left for charity at the end of the day. So we've paid less in taxes, and we are also benefiting charity. Another option is for the beneficiary, your kids, to receive this income for their entire lifetime, similar to how the Stretch IRA used to work before the Secure Act of 2019. In this one, I did a little bit more of a conservative payout, 5% payout, but over the beneficiary's lifetime, over your kids' lifetime, they're actually going to receive more than $2 million from this trust. In total, they're going to pay less than $800,000 in taxes. And this trust has grown over time, and so there's even more left for charity at the end of the day. So these are just fantastic considerations to get more money to charity. You're still supporting your family or you as the donor, and the entire remainder is going to be available to give to your preferred charities. So just a few ideas, hopefully a few new things to consider, different assets that you can give to charity. Wanted to allow some time for questions, and I'll be able to stick around for a little while if you have any unique questions specific to you as well.
So thank you, Stephanie. As she's mentioned, you can please use your question and answer or chat to any questions. So one of the questions typically comes up, Stephanie, how does someone work with you? What does a donor advised fund cost at WaterStone? Can you explain a little bit about the cost associated with it?
Yeah, absolutely. We have a really easy online application on our website to open up an account. We do have an annual administrative fee. So we charge it on a quarterly basis based on the daily asset balance. On average, it's around 1% on an annual basis. So kind of similar to how investment managers are going to charge an investment management fee based on the balance of your account. Very, very similar in this 1% annual administrative fee. if I am helping with a real estate gift or a privately held business interest gift, kind of a non-traditional asset, we do have a one-time incoming fee that we charge based on the appraised value of that property. And that fee is typically around 3%. And again, that's just a one-time incoming fee.
Okay, perfect. And also another question that also comes up is, can nonprofits use a donor advised fund as how they receive money to be able to support their nonprofit? Can you explain that in a little more detail?
Absolutely. We have an account that we call a charity advised fund. And so it works a little bit the inverse of a donor advised fund. So for a donor advised fund, there's typically one donor that supports multiple charities. For a charity advised fund, we have multiple donors that support one charity. So we can set up a charity advised fund for your organization, and we can help you to receive these appreciated stocks, these real estate, the privately held business interest. We can help to receive that for your organization. We can help to liquidate it. And once it's liquidated and in cash form, we can write a check to your organization and send a grant to you.
And is that also a fund that they can actually just take this, $25 donations on a monthly basis, as an example?
Typically not. Most organizations, if they're a 501c3, they've already got kind of a system set up to receive those cash contributions. We're happy to discuss if you have questions, but we've found that the most value we can provide is being able to receive these non-cash assets on your behalf and allowing your donors to make some of these larger contributions that we can still get to you. But most of them, if you're kind of a startup charity, we do have some accounts and some ways to help. So feel free to reach out, and we can always get you connected with our giving strategies team, kind of our customer service team, to help find a way to make sure we're helping you process your gifts most efficiently.
Perfect. Well, I do appreciate your time, Stephanie. And of course, for those that are on the call, make sure you take a look at the chat. Those are ways that you can reach both Stephanie and myself. And without further ado, Stephanie, I really appreciate your time today. Thank you so much. Definitely learned a lot on this call. And for those that are also on the call, just know that this is an opportunity that if you have your own advisor, you can still take that to your advisor, especially if you have that larger donation amount of $250,000 or more, and what that looks like. And again, if you have a large taxable event coming up, remember what Stephanie said was to give first versus sell first. Is that correct?
Awesome. Give first, then sell.
Yes. Well, thank you so much. God bless everyone. Thank you for your opportunity. Looking forward to connecting. For those that are listening only, my phone number is 813-710-4123. Again, 813-710-4123. You can reach me by phone call and text. Thanks again. God bless everyone and have a blessed day. Thank you so much. Thanks, Stephanie.
Thanks, Michael.